So as we get started on the objective 2, we're going to go back to that depreciation that we talked about in chapter 3 when we first did that journal entry and I introduced the concept of depreciation. So again, make sure you have your notes, you have a pencil, and really you want to have a calculator with me as well, or with you as well, so that as we're going through this again, you can stop, pause the video, try to work out the problems for yourself, and then restart the video so you can make sure that you check your answers and listen to the explanation. So remember, depreciation is an allocation process, not a valuation process. The idea is that we have these assets and that we are using them up, but plant assets we're using up over a period of time over several years. Remember, the matching principle says that the expense, the asset that's being used up, has to be matched with the revenue that is generated. So every year I have to record depreciation to show how much of this asset that I've used up. I can't wait till the end because that wouldn't match with the revenue. So I'm using this equipment to generate revenue now. I have to record the expense, the amount of the asset that I used up now. So that's the concept of depreciation. So we talked about this briefly back in chapter 3. We looked at one method of calculating depreciation. We're going to go back over that method and look at a couple of more. But regardless of what method you're using, there are three things that we need to know before we can calculate depreciation. Number one, we need to know the capitalized cost. Now, we talked about this in objective 2. Remember, the capitalized cost is everything we've debited that asset account for. So it's the purchase price, the sales tax, the shipping, the installation, everything we have to do to get the asset ready for its intended use, all of that. So this is a known amount. We know what the capitalized cost is. We also need to know what the useful life is. Now, the useful life is estimated. And the useful life is not how long we expect this asset to last, but how long we intend to use the asset. So in a couple of slides, we're going to start using an example where we've bought a company truck for Smart Touch Learning. We bought the truck, we had to pay the tax, title, and license like you have to do when you buy a vehicle. We had to pay to have our logo painted on the side of it and all that kind of good stuff, but we've got it ready. Now, this truck may run for 10, 15, 20 years, but we estimate that we're going to use it for 5 years, and then we're probably going to resell it and get something new. So the useful life is how long we intend to use it. The last thing we need to know is what's called the estimated residual value. Okay, now again, this is an estimate. This is how much we expect to get for the asset at the end of the useful life. So when we're talking about that truck, this is how much we expect to be able to sell the truck for in 5 years. Obviously, this is an estimate. We don't know exactly how much we're going to sell it for in 5 years. We don't even know that we're going to use it for exactly 5 years. It's just an estimate. Okay. You will also hear residual value called salvage value, resale value, trade-in value. All of those terms are used interchangeably. Now, what we call the depreciable cost is the cost minus the estimated residual value, that capitalized cost minus the residual value. This is how much of the asset we are expecting to use. Okay. In other words, this is how much we are expecting to depreciate the asset by. Now, there are three methods of there's a ton of methods of depreciation. There's a bazillion methods of depreciation. We're going to look at the three most common methods. Now, the date that we're going to be using for all of them is, remember we bought that truck. We said that the truck cost us, we know the truck cost us $41,000. That's the capitalized cost. We are estimating that we're going to use this truck for 5 years or 100,000 miles. That'll become important in a little bit. And at the end of 5 years or 100,000 miles, we think that we'll be able to just trade in or sell the truck for just $1,000. Okay. So the first method we're going to look at is straight line. This is the one we looked at very briefly back in chapter 3. It is the most commonly used method. The idea of straight line is that you get an equal amount of depreciation every year. So our formula for straight line is cost minus residual value. In other words, we also know that this is called the depreciable cost divided by the useful life, and this is useful life in years. Okay, so in our scenario, the cost of the truck was $41,000 and the residual value was $1,000. So our numerator is the depreciable cost of $40,000. We think we're going to use $40,000 of this truck's life over a 5-year period. So if we crunch those numbers out, we get our numerator of 40,000 divided by 5 years. We're going to take depreciation of $8,000 a year. So remember our journal entry we learned back in chapter 3. Every year when we do those adjusting entries, we're going to do the same entry for 5 years. We're going to debit the depreciation expense account and credit accumulated depreciation. Remember that accumulated depreciation is a contra asset account. It has a normal credit balance. Okay. So what you see next in your notes is a large chart. This is called a depreciation schedule, and we're going to fill it out for the asset for every year so that we know what the asset depreciation is, what the book value is, and all of that stuff. So we're pretending that we bought this truck on January 1 of what we're going to call year 1. Okay, and we paid $41,000. So if you remember, the book value, we talked about this back in chapter 3, is the cost minus the accumulated depreciation. This is how the asset will appear on our balance sheet. Remember, we list the asset at its cost, and then we subtract the accumulated depreciation, that contra asset, and that gives us what we call the net book value, or just the book value. So when we first buy the asset, we record it at $41,000. I debited truck, I credited cash or notes payable, however I paid for it, for $41,000. So it's on my books at $41,000. I have not recorded any depreciation yet. So here I get to the end of year 1, to December 31 of year 1. I already know that I'm going to record $8,000 of depreciation expense. I'm going to debit depreciation expense for $8,000. I'm going to credit accumulated depreciation for $8,000. So remember, if we look at our accumulated depreciation T account, I'm going to credit it for $8,000 and I will have debited depreciation expense for $8,000. And the truck is sitting over here in my T account at $41,000. Okay. So on the 12/31 of year 1 balance sheet, I'm going to list truck at $41,000. I'm going to list accumulated depreciation of $8,000, and that's going to give me a book value of $33,000. So now I'm going to use the asset for a whole nother year. So we are now at the end of year 2, 12/31 year 2. I'm doing my adjusting entries. I'm going to do another adjusting entry to debit depreciation expense and credit accumulated depreciation for $8,000. So I'm going to post those over here. Notice I didn't touch the truck. So at the end of year 2, I'm going to list on that balance sheet, I'm going to list truck at $41,000. Now notice accumulated depreciation has a total balance of $16,000 in it because 2 years of depreciation has accumulated. Therefore, my net book value is $25,000 on that year's balance sheet. So now we jump forward a whole nother year. It's now 12/31 of year 3. I'm doing my adjusting entries. Again, I'm going to do an adjusting entry for depreciation where I debit depreciation expense for $8,000 and I credit accumulated depreciation for $8,000. So now the balance in accumulated depreciation is $24,000 And notice on that year's balance sheet, the year 3 balance sheet, the book value is just going to be $17,000. So as the accumulated depreciation increases, the book value decreases. So now jump forward another year. It's 12/31 of year 4. I'm still using the truck. I'm doing my adjusting entries. I'm going to do an entry to debit depreciation expense for $8,000 and credit accumulated depreciation for $8,000. Now the balance in accumulated depreciation is $32,000, and notice the book value is $9,000. So here we get to the end of year 5. This is how long I intended to use it. I'm at the asset's useful life, into the asset's useful life. I'm going to do one more adjusting entry where I debit depreciation expense of $8,000, credit accumulated depreciation for $8,000. Now the balance in accumulated depreciation is $40,000. Notice the book value is $1,000. So at this point, I'm expecting to sell the asset really soon, right? Now, we'll talk about a little later what happens when you change your mind, and by the way, you don't sell it at the end of year 5, but we're just going with our original estimate here. There's a couple of things I want to point out. Notice, first of all, the sum of the depreciation expense. If we were to total all the depreciation expenses up, notice that they equal $40,000. So if you were to total this column up, the sum of this is $40,000. Also notice that the balance in accumulated depreciation is $40,000. Now $40,000 should sound very familiar. Remember, that was what we said was our depreciable cost, the cost minus the residual value. This is not a coincidence. At the end of the asset's useful life, the balance in accumulated depreciation has to equal the depreciable cost. I also want to point out, notice the book value is $1,000. Remember, $1,000 was our residual value. Again, not a coincidence. At the end of the asset's useful life, the book value has to equal the residual value. It has to. Okay. So again, I want to point out the book value is the cost minus the accumulated depreciation, and that's how it will appear on the balance sheet. So that last column shows us what the balance sheet will show at the end of each of the years. Now, the second method we're going to look at is what's called units of production. Units of production doesn't take the same amount of depreciation every year like a straight line does. Units of production varies based on how much you use the asset. So this isn't an appropriate method for all asset types. It's got to be an asset that you can measure the usage of. So you wouldn't want to use this for, let's say, a building. But it is good for equipment or vehicles or things that you can measure the usage of. So a car, you can measure the miles driven with the idea that the more miles you drove, the more that asset's useful life you use, therefore the more depreciation you will take. If it's something like a copy machine and you can measure how many copies were made, or a pitching machine if you're the Rangers and you can measure how many pitches it threw, then this would be a method that you could use then. The difference is, though, is that depreciation is going to vary with usage. So here we're told, we're given the example, remember, we expect to drive our truck 20,000 miles the first year, 30,000 miles the second year, 25,000 the third year, 15,000 the fourth, and 10,000 the fifth year, for a total of 100,000 miles. Remember, 100,000 was one of the useful lives that we were given at the beginning. So your formula for units of production is first to calculate a depreciation per unit. And this is really per unit of measurement. So in our case, it would be depreciation per mile. Okay. If you were measuring a copier, it would be depreciation per copy. Or if it was a pitching machine, a depreciation per pitch. So notice the formula. It's very similar to straight line. In fact, the numerator is exactly the same. It's your cost minus residual value, or the depreciable cost. But the denominator is useful life in that units of measurement. So we won't use the 5 years, we'll use the 100,000 miles. So in our example, our depreciation is going to be 41,000 minus 1,000, or the numerator of 40,000 divided by 100,000 miles, or we're going to take 40 cents per mile. Then to calculate the depreciation for a year, we'll multiply that rate by how many miles we drove it. So for example, in the first year, we drove it 20,000 miles. So 40 cents, pardon me, times 20,000 miles. In year one, we're going to take 8,000 of depreciation. Now, the fact that the straight line was also 8,000 is just a coincidence. Don't let that throw you, okay? So now we're going to go back over here to our chart. We're going to fill out another schedule of depreciation using the units of production method. Notice in year one, we still have the asset cost of 41,000, which makes the book value be 41,000 because we have not recorded any depreciation yet. I just want to write up here, remember that book value is cost minus accumulated depreciation, just so we remember. So at the end of year one, we already said we know our depreciation is 40 cents per unit. We're going to drive the truck we drove the truck 20,000 miles. This is not an estimate. We know we measured it on December 31st before we did the adjusting entry. So I'm going to do an adjusting entry to debit depreciation expense, credit accumulated for 8,000, and that leaves me with a book value on that year one balance sheet of $33,000. So for year two, we drove the truck 30,000 miles. So when I multiply that out, that means 40 cents per mile times 30,000 miles gives me 12,000 of depreciation expense. So I'm going to debit depreciation expense, credit accumulated depreciation for $12,000. So if I'm looking at my T accounts up here, I have depreciation expense. I first debited for 8, and now I've debited for 12. And I have accumulated depreciation that I first credited for 8, and now I've credited for 12. So the balance in accumulated depreciation now is 20,000 on my balance sheet. So I'm going to list truck 41, accumulated depreciation of 20,000, which gives me a book value of 21 on the year 2 balance sheet. So in year 3, we drove the truck 25,000 miles. So 40 cents per mile times 25,000 miles gives me 10,000. So on December 31st of year 3, I'm going to do an adjusting entry to debit depreciation expense for $10,000. Come on. And credit accumulated depreciation for $10,000. So now the balance in accumulated depreciation is $30,000. So on my balance sheet, I'm going to show truck at 41 minus accumulated depreciation of 30, which leaves me a book value of 11. In year 4, I only drove the truck 15,000 miles, so that is depreciation of 6,000. So I'm going to do my adjusting entry to debit depreciation expense for 6,000 and credit accumulated depreciation for 6,000. So now the balance in accumulated depreciation is 36. My balance sheet's going to show truck at 41, accumulated of 36, leaving me a book value of 5. So now the last year, I only drove the truck 10,000 miles this year, so that's just depreciation of 4,000. So I debit depreciation expense for 4,000, I credit accumulated depreciation for 4. Now the balance in accumulated depreciation is $40,000. Notice that's exactly what it was in straight line. Again, this cannot be a coincidence because the balance in accumulated depreciation has to equal the depreciable cost. So my balance sheet's going to show truck 41, accumulated depreciation 40 for a book value of 1, which again, it has to because 1 is my residual value. And if you were to add it up, the total of the depreciation expenses would still be 40,000. So we're still depreciating the same amount over time, but it's different every year. So the last method we're going to look at is called double declining balance. Now, double declining balance is what we call an accelerated method. There are a lot of accelerated methods. Double declining balance is just the most common of the accelerated methods. When we say an accelerated method, what we mean is we're going to take the most depreciation in the first year, a little bit less in year 2, a little bit less in year 3, and it's going to slowly decline over time. So that the depreciation more closely follows the actual decline in the fair market value. Now remember, under depreciation, we are not in any way, shape, or form attempting to estimate the actual fair market value of the asset. So when we look at the book value, we are not saying this is what the asset is worth or this is what we're expecting it to sell for. That's not playing any role in it. But let's just talk about a car. We know that when we buy a car, it's going to lose the most value in year 1. And then it's going to lose a lot of value in year 2, but not as much as it did in year 1. And then it's going to lose a little bit less value in year 3, and so on and so forth. So the accelerated methods more closely approximate that decline in fair market value. Now, again, I told you that double declining balance is just the most common of the accelerated methods. You could use triple declining balance, 1.5 times declining balance. There's all sorts of derivations. There's not a rule. So the formula, though, is very different. So I want you to notice this. So notice that the formula for double declining balance, and I'm going to kind of rewrite it here. So double declining balance is first cost minus accumulated depreciation. Remember, that's what we called book value in the charts. So double declining balance is really taking the book value and multiplying it by 2 over the useful life. And this is the useful life in years. So the 2 in the numerator is what makes this the double in double declining balance. If you were wanting to use triple declining balance, you would use, for example, a 3 up there. If you were wanting to use 1.5 times declining balance, you would use 1.5. So I think this formula is a little easier to read than the way they write it in the book. So if we were going to look just at year 1, the first year that we bought the asset, remember we paid $41,000 for it. So for year 1, we haven't recorded any depreciation yet. So the year 1 depreciation is, the year 1 book value, I should say, is $41,000. So $41,000 times 2 over the useful life of 5 is what gives us our year 1 depreciation. So if you pull out your calculator and throw that into your calculator, so we're going to say $41,000 times 2/5, then we get depreciation in year 1 of $16,400. That's how much depreciation we're going to take in year 1. So let me erase this so we can see. Okay. So that's what they get to. So if we go here to our chart, we're going to start off with our January 1, year 1, $41,000. So on December 31st of year 1, I'm going to do a journal entry to debit depreciation expense for $16,400, credit accumulated depreciation for $16,400. So I'm going to draw my T accounts up here. Now notice that this is more than double the straight line rate. Remember, the straight line was $8,000 per year, so this is more than double. So then on my year 1 balance sheet, I'm going to show truck at 41. I'm going to subtract accumulated depreciation of 16,400, and that gives me a new book value of 24,600. So for year 2, I'm going to calculate the year 2 depreciation by saying 24,600, last year's book value, multiplied by 2/5, and that gives me 9840. So I'm going to do a journal entry to debit depreciation expense for 9840, credit accumulated depreciation 9840. So that leaves my balance in accumulated depreciation of 26,240 if I've done my math correctly. So my balance sheet will show truck at 41, accumulated depreciation of $26,240, book value of $14,760. Now I'm going to encourage you to try years 3 and 4 on your own. Don't go to year 5 yet, but pause the video and try years 3 and 4 on your own, and then come back and restart it and we'll check and go through it. All right, so I'm hoping you've restarted. So for year 3, I'm going to take the book value of $14,760, multiply that by 2/5, and I get $59.04. So my adjusting entry at the end of year 3 will be to debit depreciation expense by $59.04, credit accumulated depreciation for $59.04. So on my year 3 balance sheet, I'll show truck at 41, I'll show accumulated depreciation of 32,144, and that will give me a book value of 8856. So for year 4, I'm going to take 8856 multiplied by 2/5, that gives me 3542. I'm going to do an adjusting entry to debit depreciation expense for 3542, credit accumulated depreciation 3542. So then my balance sheet's going to show truck at 41. My balance and accumulated depreciation is now 35,686, which gives me a book value of 5314. Now, if you went ahead and did year 5, then you'll notice that it doesn't work out exactly right. And here's the tricky part with double declining balance. The last year never works out right. But we know that in the last year, if you remember, we know that accumulated depreciation has to equal the depreciable cost, which in our case is $40,000. And we know that the book value has to equal the residual value, which in our case is $1,000. So for year 5, whatever the last year is, whether it's year 5, whether it's year 7, whether it's year 3, whatever the last year is, it's never going to work out on its own. If you were to multiply 5314, let's just do it here. I'll erase this and we'll just illustrate the wrong way to do it. If we were to multiply 5314 by 2/5, we would get, and I'm rounding here, depreciation expense of $21.26, which would give me accumulated depreciation of $37,812 and would give me total book value of $31.88. But we know this isn't right. These numbers can't be right because we know that accumulated depreciation has to be $40,000 and we know the book value has to be $1,000. So the last year's never going to work out right. What we're going to have to do on the last year is force it. We have to figure out what amount we have to depreciate it by to make accumulated depreciation be $4,000 and to make the book value $40,000 and to make the book value be $1,000. So to do that, we can say the difference in 35,686 and 40,000 or the difference in 5314 and 1,000 are the same values. So in this case, I'm going to take 4314, which makes the accumulated depreciation now be 40,000 and makes the book value now be 1,000. So now the accumulated depreciation equals the depreciable cost and the book value equals the residual value. So again, the thing is the last year's never going to work in double declining balance. You're going to have to force it. Okay. Now, what happens when we don't buy the asset on January 1? Well, that means in the first year, we'll have to prorate the depreciation. So we use what's called a modified half-month convention, which means if you buy the asset before the 15th of the month, you'll take the whole month. If you buy it after the 15th, you'll take you won't take that month. Okay. So for example, let's say that we purchased an asset on, I'm just making things up here off the top of my head, but let's say that we purchased an asset on April 3rd. Then we'll include April in our prorate. So we'll say, okay, so we use the asset all of April, all of May, June, July, August, September, October, November, December. So that's 9 months. So in that case, we would take 9 months of depreciation, or we would multiply the annual depreciation by 9/12. Let's say, for example, we bought the asset on April 18th. In that case, we would not include April. We would assume, for example, round that we bought it in May. So in that case, we would only take depreciation for May, June, July, August, September, October, November, December, or 8 months. In which case, you would multiply the annual depreciation by 8/12. Okay. So in this example, we have the same data as before, but instead of buying the asset on January 1st, we're buying it on July 1st. So instead of taking a full 8,000 of depreciation in that first year, assuming we're using straight line, we're only going to take half a year. Now, one thing I want to encourage you, don't be afraid to count on your fingers. A lot of mistakes I see students make are just from carelessly miscounting the months because you're trying to do that in your head. Count this out on your fingers. If I bought it July 1, that means I'm counting all of July, August, September, October, November, December, or 6 months. So we know that the depreciation rate is 8,000 a year because we've already calculated that before. But if we wanted to just do it from start, we know that it's 41,000 cost minus the 1,000 residual divided by 5 years. That gives me $8,000 per year. For year 1, though, I'm only using it 6 out of 12 months, so I would say 8,000 times 6/12, meaning year 1, I would debit depreciation expense, credit accumulated depreciation for 4,000 instead of 8,000. Year 2, 3, 4, 5, I'm going to take 8,000. So let's look at this. I don't have a whole chart prepared for you, but let's just think about this. So year 2, I'm going to take the full 8,000. Year 3, I'm going to take the full 8,000. Year 4, I'm going to take again the full 8,000. Year 5, which we think is the last year, I'm going to take the full 8,000. But notice, this isn't really the last year because at this point, I've only used the assets for 4.5 years, not a full 5 years. So when I don't use it that full first year, I'm going to go into year 6. And year 6, I'm going to say this is 8,000 times the other half. So this would be $4,000 again in that year 6.